episode 130, and we have a very special guest on. So his name is Arn Cenedella. So a little bit of history background of Arn. He's been a real estate broker and investor for over 40 years, born and raised in the Francisco Bay Area. So Arn sold property in Silicon Valley and investing there as well as across the country. He accumulated a portfolio of family rentals and is now in the process of moving equity into larger multifamily deals. Now, as a resident of the Greenville, South Carolina, Arn helps people invest in Carolina multifamily properties. And for more information, of course, you can go to the investwoodspark.com. By the way, great name there. Facebook, LinkedIn, links are going to be down below. So make sure that you go and follow up with Arn during or before the interview. But Arn, just personally, I want to say a big thank you for being today on the show.
Hey, thanks for inviting me. I'm excited to share my story and hopefully help your listeners.
Beautiful, beautiful. Thank you so much for taking the time to do this today. So kind of the first question, I mean, 40 years, in real estate industry, I mean, that's quite a journey, so far. So can you talk about kind of the beginning stages and like 40 years ago, where did your journey started and how did it start for you personally?
Sure. Happy to share my story. So I was kind of the typical kid. It was kind of assumed I'd go to college. I did well in school. Got a bachelor's degree from Colgate University in chemistry, then went on to the University of Michigan, got a master's degree in physical chemistry. And then at about the age of 22, I kind of decided, maybe that's not exactly what I want to do. So I called my father up, who was still back in the Bay Area, and I said, hey, Dad, I'm going to finish up school, want to come back to California. And he said, well, great, come on out, get your real estate license, and I'll put you to work. So that was 1978. I was probably 22 or 23 at the time. So there was no long-term plan to get into real estate. It's just kind of how my life evolved. And from 1978 on through to about 2014, my office was in Menlo Park, California, kind of right north of Silicon Valley, next to Stanford University, and had the good fortune to sell real estate in probably the best residential real estate market in the world, San Francisco Bay Area, San Francisco Peninsula. And that's how I kind of got into real estate. And here I am 40 plus years later.
Here you go. So, and the journey still continues.
The journey still continues. And I'm now 66. I just received my first Social Security check last month, which is wonderful. But as most of your listeners probably know, Social Security really isn't going to cover your expenses, maintain the kind of lifestyle that you've worked hard to create over decades. And so real estate investing is a big part of the financial security and freedom that I currently own, currently enjoy. And my father was kind of an old school investor. He started buying single family homes one at a time and kind of built a portfolio over 10, 20 years of single family homes. And being the good son that I am, I followed in his footsteps. And as I got into the real estate business, I bought my first home in 1980. And your listeners may be shocked to understand I paid 11.75% for my first mortgage. So when I see mortgages at 3.5, 2.75, it's kind of an amazing juxtaposition to what mortgage rates were when I broke into the real estate industry. And And I was fortunate to get 11.75 because shortly thereafter, mortgage rates went up to 16, 17, early 1981 and so forth. So I think I started my real estate investing career like many people. I bought a home to live in. I lived in that 6 years, moved out, kept it as a rental. And as my brokerage business grew and my income increased, I would save money to buy more rental properties. Sometimes I'd refinance an existing rental property to generate cash for the next one. Other times I would 1031 out of one single family house and kind of multiply that money and buy 3 houses with the equity in the first one via 1031, defer any payment of taxes. I invested in the San Francisco Bay Area, but as people know, home prices are very expensive there. It's not really a cash flow market. So over time, I started investing in Charlottesville, Virginia, and Austin, Texas. Did particularly well in Austin, Texas, which most people know is kind of a boom market. And that's kind of how it developed. I've probably owned 30 or 40 rentals at the present time, maybe about 12 with maybe about 20 doors. So I'm not a huge property owner, but I have a nice portfolio. It's done well for me over the years. And we can discuss a little further kind of why I'm making the change and moving into larger properties at this time.
Yeah, okay. So the question that I have, again, looking back at the time, and you mentioned like in California, that was the 1974, 78, you mentioned. So
78 I started.
78. So I mean, at that time, can you just take us back, with the time machine? Because again, at that time, I wasn't even around, when you were, getting involved with the real estate business. So that's fascinating. Yes. I mean, so looking at the differences when it comes to the, of course, obvious one is the price changed throughout the times and appreciated. There's a lot of properties which appreciated, like when it comes to California and San Francisco Bay Area, that's probably why the investors invest, for the appreciation part, right? And of course, yes, the mortgage. So as you mentioned, there was 11 point something and now it's 2 point something. So the difference is there. Yes. So what are the other reasons that you're seeing over the years when it comes to the market change that you're seeing in those markets?
Well, so speaking specifically of the San Francisco Bay Area, when I got into the business, we'd have a rule of thumb in Menlo Park, Palo Alto. It would be about $100,000 a bedroom. So a 2-bedroom house might be $200,000. 4-bedroom house might be $400,000, and this would have been back in the late 70s, early 80s. Prices today, it's probably more $1 million a bedroom. So 4 bedrooms could be 4 million. The land value is probably 2 million itself now. And so the San Francisco Bay Area, Silicon Valley, particularly experienced unbelievable appreciation over time. And I would say that's just primarily due to the kind of advent of Silicon Valley and technology, which created great opportunity and great wealth. We have 2 great universities there, Cal Berkeley and Stanford University, which were like a feeder chain for Hewlett-Packard, Google, Facebook, amazing academic institutions. And I think what happened was people from all over the world recognized the opportunity in Silicon Valley. And if I was a young person today and I wanted to kind of create my fame and fortune, there's probably no other place I'd go in the world. So people from all over the world flocked there, oftentimes would go to college there, either maybe from China or India. Certainly, many folks from Europe, from Russia came to Silicon Valley. And so an energy and a desirability was created there. And when a relatively small geographic area becomes a world-class area where people all over the world want to move to, and you have limited housing supply, limited land, prices are necessarily going up, and the incomes that were created, the IPOs, the stock options, created a situation where prices increased beyond belief, actually. And I can remember many times throughout my career, I'd be looking at houses with other brokers, other realtors, and we'd sit there and we'd go, how can prices go up anymore? I mean, this house is 2 million. And of course, they kept going up. And so it's really an interesting phenomenon. And even now, from what I understand, my friends back in the Bay Area, the market there has softened, but no real fundamental disruption. The things that attract people to the Bay Area still exist, not to mention great culture, great weather and all that, but it's more the economic opportunity, primarily through technology, that brought people there.
Got it. So you made the move, you made the transition from state of California to Texas, or you moved to Greensville, South Carolina right away?
I moved to Greenville, South Carolina. So my girlfriend of 16, 17 years, my life partner, worked for Intel back when they developed the Centrino chip that really started mobile technology. That was the start of the whole mobile generation. She's worked for Visa, and then last she worked for Intuit. So she, though she's not a techie, has had kind of a typical Fortune 500 Silicon Valley type career, where I've always been an entrepreneur, a real estate broker, and an investor. And we had lived in California most of our life, and we were just kind of ready for a change and a new adventure. So we took 2 or 3 years traveling around the country, visiting various spots, not looking at houses, just kind of going to have fun, to check out the vibe of various communities. And we visited the Central Coast in California, San Luis Obispo, where she went to college. We checked out Prescott, Arizona. We considered Austin, Texas. And then we kind of zeroed in on the Carolinas. And through a 2-minute conversation with somebody we knew in Asheville, we heard of Greenville, and we visited. We were here about 3 days. As we turned down Main Street to drive to the hotel, we both started to kind of cry. It's a silly story, but I think when you have kind of a vision of what you want your life to be and where you want to be, when you see it, when you find it, there's an emotional reaction. So,
I get it.
You're right. Our visit was 3 days, and we went back home. And then about a month later, Laura came home from work, and we sat on the couch, and she started to cry because she had a rough day at work. I mean, the downside of living and working in Silicon Valley is they work you hard. There's expectations, there's pressure. You don't get paid good salary for not hard work and effort. Yeah. And she had a rough day, and I just kind of said to her, hey, honey, we don't have to do this anymore. And that kind of was the impetus to start the move to go to Greenville. Took us about 6 months to wrap it up. She had a condo to sell. I had a house that I'd owned for 28 years and owned 2 boys, or raised 2 boys in. So that was quite a job getting that ready. Trust me, it was a bachelor pad. But anyway, about 6 months later, we rolled into Greenville, and we've now been here about 6 years and love it. So we're very happy with the move. Honestly, some of our friends back home probably thought we were crazy moving to South Carolina. I mean, do they even have internet? Well, I don't know. I got to find out. So, but any case, our friends who have visited understand what we see here. And so we're very happy here. And I like the real estate market so much. I started buying rentals here, and now I'm transitioning into multifamily. Again, wasn't part of any long-term plan. It just kind of fell into it. And I'm having fun doing it, and I'm having fun helping other people do it.
Awesome. So that was my initial question that I wanted to ask. When you made the move to Greenville, South Carolina, have you purchased any single family residences? By the way, it sounds you did. So can you talk about the transition and an event, or was there a person that got you involved with the multifamily?
So that's a great story too. It's a great question, and it's always interesting who comes into your life to impact your life in a positive way. And sometimes it's just often surprising. So I'm a big fitness guy, and so going to the gym is part of my daily routine. I love playing golf, and so I found a gym in Greenville, and I'm on the treadmill, and next to me is this handsome young African-American kid, and we start talking. And of course, he's in real estate too. So his name was Mario. We've developed a friendship over the years, and we've become friends, kind of business associates, and his career has been fast-tracked. When I met him in 2014, he was flipping single-family homes, just starting to flip single-family homes. Now here at 2020, he's completed 3 or 4 multifamily syndications. Really sharp kid, great personality, just a pleasure to know. So we've developed a friendship, and in the middle of March, when COVID hit, Mario calls me on the phone one day and he goes, "Arn, what do you think COVID's going to do to the real estate market? What do you think it's going to do to rent collection?" And I go, "Well, Mario, I don't know." Ask me April 1st and I'll let you know how many, what rents I collected. So we had a nice conversation, and he goes, "I'm going to send you a podcast about COVID and about a guy I met at a multifamily conference." Well, it turned out it was a Neil Bawa podcast. Neil's from the Bay Area, Fremont, California, in the East Bay, and a very successful syndicator. And so Mario sent me the podcast, and I listened to it. And honestly, a light bulb kind of went off. And I became, I don't know what you'd say, obsessed with learning about multifamily. So at that time, the gyms were kind of closing down. So to get my exercise, I'd take 3-4 hour bike rides in the day on my bicycle on the Swamp Rabbit Trail. And so I would download podcasts on real estate, and I would listen to them on my 3-4 hour bike ride. And so I just started learning, consuming knowledge. I mean, podcasts like yours and others provide people access to great information that they can use to better their lives and improve their financial situation. So the information is there. You just have to take the time to go find it. The other thing that happened was at the beginning of every year, I prepare a spreadsheet with all the properties I own, figure out what they're worth, what the mortgages are, what equity I have. I look at the rent collected, my expenses. So I have like a snapshot of my real estate portfolio. And it's done very well, particularly on the appreciation side. But when I looked at my cash flow return on my equity, the annual amount of money I put in my pocket, it was probably only about 3 to 4% of my equity. And, again, the properties are going up in value. There's nothing wrong with that. They're good properties. I have great tenants and I enjoy managing them. But I think as one moves through life and transitions from, say, peak career, early career, mid career, peak career, one's investing focus might change. I would say early on, when you're making good money, you don't really need the cash flow to live on, what I believe one should focus on is increasing your net worth, because at the end of the day, the size of your nest egg is going to be the primary determinant of what your cash flow is later on in life. At least that's my opinion. So I think early on, a focus on capital growth is appropriate. But as one gets older and is leaving their peak income years, then I believe the scales kind of tip more to cash flow. And that's where I'm at now. I'm 66. I'm still busy at work. And of course, the notion of retirement has changed. My girlfriend and I were talking about our grandparents back when we were kids, who would have been the same age we are today, if that makes sense to you. So when I was 10, my grandfather was 65, and our lives are totally different from my grandparents. People are living longer. The definition of retirement is kind of different. It's not the end of your life. In many ways, it's just the beginning of the opportunity to really live the life that you want. And if that means painting or playing golf or volunteering at your church or your community or mentoring, whatever it is, it gives you the opportunity to do the things most close to your heart. And so for me, I'd like to maybe be less hands-on involved in the day-to-day activity of managing rentals. It's not a lot of work, but you might have 10 or 15 mortgages to pay, 20 or 30 rent checks to deposit, insurance policies, property tax bills, not to mention repairs and so forth. So for me, I think the transition into multifamily is natural as I kind of move more to the cash flow side of the equation.
Definitely kind of natural progression or evolution for your own personal real estate business. So it does definitely make sense, because for a lot of multifamily syndicators, the ones who are kind of new in the game, they do understand the benefits of it. One of them is the economies of scale, what you mentioned, instead of handling 15 different properties and tenants and the insurances and the mortgages. If you want to buy these 15 units, you can buy one property, which is going to be one mortgage, one property management company. So there is a lot of great benefits for multifamily business.
Yes, the economies of scale is definitely one of them. Like if a lot of people like to invest in kind of Class C value add type properties, and I would say they're akin to single family flips and fixes, right? But the beauty of having an apartment building is once you get the game plan down on one unit, how you're going to renovate it and upgrade it, you don't have to reinvent the wheel for the next unit, right? Where if you fix and flip a house, each house is different and you got to kind of come up with a different game plan. Mm-hmm. So I think the ability to kind of systematize the upgrading of the units is certainly an economy of scale. The property management, Single family homes, people will pay 8 to 10% of the rent as a property management fee, not complaining, not saying it's too much or too little. It's just the reality. On a larger apartment building, people may be paying 2.5 to 3% for management. When you get up over about 100 units, you can have on-site leasing person and an on-site maintenance person. And as we all know, anybody who owns a home, when you have to call out the plumber, it's a minimum $125 charge, and you're probably going to end up with the bill of about $250. Well, when you have on-site management and somebody's on payroll, it's not costing you $150, $200 every time he goes to fix the toilet. The other thing I really like about multifamily is as you scale up your portfolio, it's harder to get attractive financing on each and every single family rental. You kind of run into a roadblock. I think Freddie Mac, Fannie Mae maybe have a limit of 10 things. It might be 5, I'm not sure. Or you have to go to a commercial loan, which has a shorter amortization with a balloon, where when you do bigger apartment deals, you can get agency financing where you can get loans for 7, 10, 12 years at interest rates right now, sub 3 in prime markets, maybe mid 3s in secondary markets, also get some interest only for a couple years. So I think the financing on multifamily properties through the agency debt is a real advantage over trying to pick them off one at a time with single family houses.
Yeah, because that's overall, you know, it's a big portion of the returns that you and the investors are going to get is how you're going to finance the deals.
Yes.
So, yeah. Okay.
Yes. And with compression of cap rates, you better have some low financing to have it make sense, right? Mm-hmm. You know, you can't borrow at 7 and buy at a 5% cap rate. It's just not going to work. You can buy at a 5% cap rate if you can finance at a 3% interest rate.
Got it. So when it comes to the deals itself, I mean, because you're right now, I guess, actively looking for deals in South Carolina. So can you talk about what's currently happening in the pipeline, what type of deals and the criteria on the deals that you're looking for?
Well, first, let me say it's difficult to pry any property loose from owners at a price that makes any sense. You know, just being honest with your listeners, it's not easy finding a properly priced asset.
Because everybody's willing to overpay. Everybody's is willing to overpay right now, right?
Well, you could say that, or you could say that's what the market is now, right? If everybody will pay a certain price, that's the market.
That's the best way to put it, yeah. Just market.
But your way of saying overpay also has some validity, you know, it's both and not necessarily either or. And so people who own apartment buildings, occasionally you may find an unsophisticated seller, maybe somebody that's owned the property 20, 30 years and they paid next to nothing for it. And it's been fine, mom and pop. But by and large, most multifamily owners that I run into are smart, sophisticated, financially savvy people. Just as every homeowner in America knows to within $5,000 what their house is worth, I would say most apartment owners have a pretty good idea of what it's worth. Yeah. So I'm out there making offers all the time. I have verbal agreement on 16 units in Columbia, South Carolina. I'm close on 40 units in Greenville, South Carolina. But it's just very hard coming to a point that it makes sense to do it. So as much as I'd like to do it, I also need to be prudent about it. And of course, I need to protect my investors too. The best deal you sometimes make is the one you don't buy, right? So I'm not going to buy a bad deal that's then going to occupy 5 years of my time to bring it back afloat. I'll just keep working at it, and I know I'll find one. I'm close. I've been close, and it's just a process, and you just have to have a little determination.
Got it. But what you're saying that you're not pushing it. I mean, if you have to wait it out and see, because there's a lot that currently happen in the market, and again, is the first of all is the COVID, second of all is the elections and what's going to happen after. So I mean, you're because there's a lot of people who are brand new in multifamily syndication. Some of those people, they have to find something. I mean, it doesn't matter the market conditions. I have to find something. I have to have the AUM right now. It doesn't matter, what the situation is.
They need to have that on their resume, and that's not where I'm at. Let me say one other thing. So I've been in business 40 years, and one of the benefits of having some long experience is I've been through a few economic ups and downs, okay? In the late 80s, we had Black Monday where the stock market dropped 30% in a day. In the early 1990s, 1/3 of every savings and loan in America went under. It was the S&L crisis, and the government took back gobs of property. Went through the dot-com boom, the dot-com bust, through the subprime crisis, and then 10 years of unprecedented economic growth, and then bang, COVID pops up. So there's some advantage, there is some sense of perspective from living through these events. And so I tend to be a little bit more steady as she goes. I'm not afraid to invest in the market now. I know there's uncertainty, but I have optimism about the long-term future. And if you buy right, pay a reasonable price, you're not over leveraged, you're properly capitalized with some good reserves, you can ride out the temporary turbulence for the longer term gain. And I guess that would be the other point. In my mind, real estate is a long-term investment strategy. Yes, people can buy and sell and make, but I think historically, if you look at people who have accumulated wealth, it's been kind of consistent investment in solid investments over time. It'd be kind of like the Warren Buffett approach, right? I mean, Warren, in my mind, he's not a wild speculator. He looks for value, he makes the investment, and he just waits the thing out. And as long as you're properly capitalized and you have a cash flow investment, you could ride it out. When you talk about newer syndicators, it's interesting because people who have got into the business in the last 5 or 10 years have only really experienced one economic market.
Unless they're coming from a real estate background.
Say from 2010 to today, things have been pretty positive economically and for the real estate market. Certainly 2008 and 9 was a hit. But by and large, we've had pretty phenomenal economic growth over the last 10 years. And so people shouldn't expect that to be the norm and what should always be expected. I mean, life is cyclical. And as my dad used to say, he goes, when the market is hot, anybody can lean up against a house and sell it. All right. But when the market's tough, when it's slow, you actually have to have some skill and expertise to navigate the market. And I don't think it's any different with multifamily investing either.
Yeah. And I mean, you can see that. And in the times like this, and that's why it's good for the buyers, and again, maybe not so good for some of the people, again, that we mentioned kind of brand new in the space, because those people will show if they have the skills or not to hold these properties during these times, and to come out of these times still owning the properties, because you probably heard the stories when a brand new syndicator loses the deal because it's getting mismanaged, because they don't know how to run the day operations. And it's good for the people like yourself who are looking to acquire deals. And I heard, operators selling a deal in Carolina. I don't think if it's been in South Carolina, but they sold the property, and they sold it for very good price. Well, for the price that the other operator was willing to pay. So they kind of negotiated. So they paid like 30,000 less per door, for the property. And it was a good deal for the people who bought it, but not so good for the ones who sold it.
Yes, and what I would say is predicting doom and gloom seems to be popular these days. It's an interesting phenomenon to me. And of course, with COVID came many doom and gloom predictions. We probably haven't seen the full impact of it yet. It may still be another 6 to 12 months till everything really shakes out. Does the government stimulus continue? What happens if it doesn't? How does that all play in? But I do know there are a lot of people waiting kind of for the shoe to drop and hope to swoop in and pick up some of these distressed properties down the road. Primarily due to poor operations. I haven't seen a lot of it yet. By and large, I think multifamily's hung in pretty good. I'd rather have some multifamily than retail right now, or even office. I think things may be a little more problematic there. I mean, the thing with COVID is going to.
Sorry for interrupting. Unless somebody who's experienced in multifamily space, because maybe you came across a few operators, because as far as I'm hearing, some people and companies are looking to redevelop existing office buildings into apartments, or hotels, and convert them into apartment buildings. So that's available option.
Yes, it is available option. Not for me, but somebody else, yes, it could very well work that way. So that's certainly true.
Okay, so that's very interesting. Again, so as you mentioned, you mentioned the 16-unit deal and 44-unit deal. So those are quite high numbers when it comes to the multifamily. So that's good. So there's economy to scale. So when it comes to structuring those type of deals from, let's say, passive investor side, how those deals are going to be structured by the SEC standards?
So these properties would be in the price range, say from about $1 million to maybe about 2.5 million. Okay, the ones I'm kind of personally looking at, and I don't see them as much as a syndication type deal. I think it would be more a joint venture type deal where I and maybe 2 or 3 of my investor buddies would go in and go in together. So I don't think they're really quite big enough. And certainly the cash flow and the returns probably aren't fat enough to have it set up well for a syndication structure. So I think this would be more kind of a joint venture structure. And kind of the team I would put together would be, I have a great property manager who wants to invest with me. So he'd kind of handle the asset management, the property management. I have a very savvy financial person who works as a CPA for a big five accounting firm. So she can handle the numbers and the accounting. And then I'm kind of more the investor relations, sourcing the deal, kind of seeing the big picture, trying to negotiate the deal. And so those would be the three main team members. And then from there, we might bring one or two other people in, just depending on how it goes. So with the joint venture, everybody kind of involved has to have a role. And if so, you don't really have to worry about SEC regulations. But that's a great question, because I think there are a lot of people kind of working in the gray areas here vis-a-vis SEC regulations. It's been interesting to watch recently how the SEC has started to amend the regulations, kind of involving this whole industry between the definition of an accredited investor, and now they're starting to talk about allowing capital raising in some kind of limited format. And I think it's all still very new. I don't think the SEC has kind of issued formal regulations on a lot of this, but it's interesting to see they're kind of starting to think about changing this.
Got it. Yeah. So good news again for the people who are maybe not accredited, so they can invest, in multifamily deals probably in the future, because this is just a kind of news update, which you said is not happening yet. But I love the fact which you said that your property manager is going to be invested in a deal. So if, potential deals, future deals also maybe. So that's a good way to kind of and that's gives you more trust about them to kind of, when it comes to, managing your properties, they're going to do a great job because there's their own money on the line. So that's a good strategy, for.
Yes, 100%. And he'll bring in some other of his family money too. So yes, and he's a great guy. I've known him for about 6 years. He started as a plumber, okay? So, and now he's moved into property management. So he's kind of a salt of the earth guy, and he runs several renovation crews for his property management clients. So I had him do one of my rental houses here in Greenville recently, kind of did a complete redo, lay down new LVT, paint, do the cabinets, light fixtures, plumbing fixtures. So he runs the crews himself, which again will save a little money as opposed to having to outsource that to a third party. So I think we'll be a great team together, and we just have to land that one. And his involvement narrows our geographic search a little bit. He probably wouldn't go down to Columbia, which is about 90 miles away, but if it's more Greenville proper, he's definitely in. Yeah.
Got it. Okay. So by the way it sounds, and I'm just assuming, probably it's not the best thing to do, which I should ask you a question, but I'm assuming that you're going to be looking for bigger deals when it comes to syndication, because you mentioned about the 14, if it's 16 or 44 unit deal, you're going to be doing a JV on those type of deals. But the bigger deals, if you will come across, on the bigger deals, probably will be doing syndication, and that's what I'm assuming. But can you talk about the deal sourcing part? I mean, what ways are you currently going about to find the deals?
Yeah, that's a $64 million question. It's what everybody wants to know, right? How do you do it? So for me, it's just networking with people. Unlike the residential business that is pretty much 99% run through MLS, right? People get properties, they post them on the MLS, so everybody has access to them. The commercial business is a little different. People tend to market their own listings and kind of hold on to them. So for me, it's networking, just talking to people, other operators, other investors, property managers, and just let them know that I'm looking. I do a fair amount on social media. I got a call yesterday from a wholesaler who I just basically put a simple post, nothing fancy, looking to buy multifamily in the Greenville area. He responded, gave me a call, and he's got a 12-unit building elsewhere in the upstate that I'm going to go see Saturday. So for me, it's primarily kind of word of mouth networking and social media. I need to systematize that more, and I have ideas to do it kind of using list source and then TLO to track down these LLCs, but I haven't quite implemented it. Recently, I've spent a lot of my time kind of building my platform, which is primarily the website that you mentioned. And now I got to kind of take it to the next step and sharpen my game on sourcing properties. But at the end of the day, I think networking's your best option.
That's it. That's the golden answer that everybody's looking for, right? It's just talking with people. Look, same strategy. It's worked since you started 1974, and it still works, right?
Yes.
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 Here you go. Here you go.
Yes.
That's awesome.
I mean, the tech is great, but at the end of the day, it's kind of a people business, and you know, I believe in karma too. If you treat people right, you're more likely to be treated right yourself. And so I think there's a way to go about in the world and business from a place of integrity and character, where you do what you say and you say what you mean, and you act responsibly and considerately towards people. It comes back around and benefits you. At least that's how I try to approach business, and I think it works for me.
Yeah, definitely agree. So, guys and girls, that's what I want to tell you. If you get in contact with Arn, again, on investingwithspark.com, on Facebook, LinkedIn, and ask him questions, you know, about multifamily investing, about the future deals, things that he's working on currently. You know, ask about the single family properties if you want to learn about investing into those. You know, just ask a bunch of questions, and I'm sure he will be, you know, he will be able to spare a few minutes to answer those type of questions. So make sure to get in contact with Arn. But for you, Arn, I really enjoyed the conversation and your personal story. I mean, 40 years, still coming back to that fact, 40 years in business, and it's still going and looking to scale the business. I mean, it's amazing. So I'm a huge fan.
Well, thank you. And it's great to keep learning. I have a lot of experience, but there's a lot I don't know. And I think somebody, or maybe it was Einstein, said, as long as you're learning, you're not dying, or something to that effect. So I'm having fun doing it, and I enjoy it. So it's a great thing for me too. Appreciate being on your show and getting to meet you. I'm so thankful for the opportunity.
That's no problem. The pleasure is all mine. So, and again, for the people, guys and girls who are watching, last thing they wanted to ask you, if you shared this episode with a friend of yours, and of course, the best case scenario, there will be a person who owns some multifamily deals in South Carolina, and he's looking to sell them, or she's looking to sell them, or that person is looking to invest passively in a deal. So make sure to share this episode with a friend of yours. Again, Arn, I appreciate you being today on the show. And as always, I'll see you next time. Thanks for watching.
Yep. Thank you so much. Have a great day.